Today, Japan is one of America's closest allies, but 40 years ago, America feared Japan the way it fears China today.
In 1989, Japan had the fastest growing stock market in the world, an economy that looked completely unstoppable, and real estate so valuable that the land beneath the imperial palace was supposedly worth more than the entire state of California. Not the whole city, not even a district, one palace. And 3 years later, it was all over. But that is not how it looked like at the time. Before Japan became a warning, it looked like the future. Right now, America is afraid of China, the rising economic superpower, buying Western companies left and right, flooding markets, threatening to displace US dominance in technology, manufacturing, and finance. But this isn't the first time an Asian power challenged the US. 40 years ago, Japan was exactly that country, and what followed, the pressure America applied, and the choices Japan made in response, triggered a chain of events that destroyed the Japanese economic miracle, trapped its economy for over 3 decades, and set in motion forces that are still shaping the global economy today. By the mid 1980s, Japan was winning. Its car companies were dismantling Detroit. Its electronics firms controlled the consumer market. Japanese investors even bought Rockefeller Center. They were, by every visible metric, richer, more disciplined, and more strategically organized than their American competitors. The US trade deficit with Japan hit $50 billion a year. Congress was furious. Some members literally took a Toshiba radio onto the steps of the Capitol and smashed it with sledgehammers for the cameras. But the anger ran deeper than just trade deficits. Japan seemed to have discovered a superior model. Government and corporations working together, workers with lifetime employment, companies that planned in decades rather than quarters. Serious economists were writing papers asking whether Japan might eventually overtake America altogether. Washington had to act, not with tariffs. That risked a trade war that would hurt American consumers. It needed something more precise, something that could quietly reach into Japan's economy and pull a lever from the inside. In 1985, it found one. On September 22nd, 1985, the finance ministers and central bank governors of the United States, Japan, West Germany, France, and the United Kingdom met at the Plaza Hotel in New York. The meeting lasted less than 2 hours. What they signed was a coordinated agreement to deliberately weaken the US dollar and by extension push up the value of the Japanese yen. Japan reluctantly agreed to the deal, but Washington had made clear that the alternative, congressional tariffs, would be way worse. The logic was elegant. If the yen becomes more expensive relative to the dollar, everything Japan sells overseas becomes more expensive for foreign buyers. Americans would simply buy fewer Japanese goods. The trade deficit would correct itself without a single tariff. It worked mechanically. Over 2 years, the yen nearly doubled in value. Japanese exporters were suddenly selling into foreign markets at twice the price. Tokyo faced a choice: accept the slowdown, let growth contract, let unemployment rise, take the pain, or find a way to replace the demand that had just been destroyed. It chose to replace it. Between 1986 and 1987, the Bank of Japan cut interest rates 5 times. By the end of 1987, the benchmark rate sat at 2.5%, lower than it had ever been. Cheap money flooded the financial system. Banks had more capital than they knew what to do with, and Japanese borrowers, conditioned by decades of rising asset prices, did what seemed rational. They borrowed heavily and put the money into stocks and property. The Nikkei stock index tripled in 5 years. By December 1989, it touched 38,900 points, a level it would not see again for 34 years. Tokyo real estate reached prices that require a moment to absorb. Prime land in the Ginza district was selling for more per square meter than anywhere else on our planet. By some estimates, the total paper value of Japanese real estate exceeded the value of all real estate in the entire United States, a country 1/25th the size. And the people buying into it weren't irrational by the logic of the time. Prices had risen every single year for decades. Every bank, every newspaper, every government report said the same thing. Land in Japan is scarce. Demand will always outpace supply. Property is the safest investment you can make. The entire financial system had quietly reorganized itself around the assumption that the bubble was not a bubble. By 1989, the Bank of Japan knew the bubble had gotten out of hand. Inflation was rising, asset prices were detached from reality, and the longer they waited, the worse the landing would be. So in May 1989, they did what central banks are supposed to do. They raised interest rates. Cautiously at first, then again, then three more times. By August 99, the rate had gone from 2.5% to 6% in 14 months. The Nikkei fell 40% in 8 months. It kept falling. By 1992, it had lost more than half its peak value. Real estate followed, slowly at first. Property markets are slower to move than stock markets. The inflated property values banks use as security to lend against them started to drop at such a scale that the risk systems of the banks got overwhelmed and they had to disclose losses. On the other side of the coin, the companies that had borrowed against their own stock portfolio experienced the same shock as their valuations dropped and couldn't service their debts anymore. So in the end, the banks stopped giving out loans altogether. The rate hikes implemented by the Bank of Japan worked in the worst possible way. Within months, the entire system seized up. Banks stopped lending, companies stopped investing, and consumers stopped spending. Prices started to fall, which on an aggregate level is way more dangerous than it might initially sound. If you expect your apartment, your car, whatever, to be worth less next month than today, you don't buy it today. You wait for next month, and then for the month afterwards, and so on and so on. And if everyone waits simultaneously, demand across the entire economy collapses, which pushes prices down further, which makes everyone wait even longer. It becomes a trap that feeds itself. Japan's economy, which had averaged 4% annual growth for 30 years, essentially stopped. And this is where it gets complicated. Because Japan didn't roll over, it fought back with everything it had. Through the 1990s, Japan launched stimulus package after stimulus package, spending over $2 trillion on public works alone. It used 30 times more concrete per capita than the United States. It built highways that ended at dirt tracks, airports in regions with no demand, and deep water ports where no ships docked. It extended its Shinkansen bullet train network, the pride of Japanese engineering, into regions that simply didn't have enough passengers to fill the seats. The construction industry ballooned to 10% of the entire workforce. And still, the economy barely registered it. Infrastructure was the first lever. Japan had another one. In most countries, central banks raise and lower interest rates the way a driver adjusts speed, constantly, incrementally, in response to changing conditions. Japan stopped adjusting. They cut rates to zero and left them there. To see just how unusual Japan's zero rate experiment was, compare the policy rates of the Bank of Japan, the Federal Reserve, and from 1999 onward, the European Central Bank. And when zero wasn't enough, Japan did something no major central bank had ever done before. In 2001, the Bank of Japan began creating money electronically, conjuring it into existence to buy up government bonds and force liquidity into a system that had stopped moving. The rest of the world called it an unprecedented experiment. Japan called it a last resort. Nowadays, we know it as quantitative easing. Japan tried everything, and it wasn't nothing. The stimulus almost certainly stopped a 1930 style collapse in its tracks, but it did not restore the old Japan. Growth stayed flat, debt kept climbing, deflation persisted. So, why didn't the standard tools work? The go to explanation is quite simple. Japan had a demand problem. People weren't spending enough. So, the textbook solution was obvious: make money cheaper, increase government spending, and demand should return. More spending means more jobs means more income, and more income means the economy starts moving again. Most of the time, that logic works. But that explanation misses something that changes everything. When the bubble burst, the assets collapsed, but the debts didn't. On paper, this company had borrowed against 80 million in property and stocks. After the crash, that collateral might be worth only 30 million, but the loan did not shrink with it. The debt was real. The collateral had evaporated. Normally, lower rates restarts the machine. Companies borrow, investment returns, and the economy recovers. In Japan, rates fell as well, but companies didn't borrow, they paid down debt, and the economy kept stagnating. Even at 0%, the rational decision for any Japanese executive was not to expand, to hire, to build, but to take every yen of profit and use it to pay down the balance sheet. Economists call this a balance sheet recession. It's a fundamentally different animal from a normal downturn. In a balance sheet recession, monetary policy, the primary lever central banks use to steer economies, loses almost all its power. You can create as much money as you want. If every borrower in the system is in debt paid on mode, that money goes nowhere. And you might ask, why not just refinance at 0%? The lower interest payments help, sure, but they don't solve the underlying problem. If you borrowed 80 million to buy something that's now worth 30 million, cheaper debt service doesn't close that gap. The hole in your balance sheet is still there, and the only way out is to pay down the principal. And that's exactly what every Japanese company did for over a decade, regardless of what interest rates did. Onto that, layer the demographic collapse. Japan's working age population peaked in the mid 1990s and has been shrinking ever since. Fewer workers means less consumption, less tax revenue, less growth permanently. The stimulus had to fight not just a debt overhang, but an economy structurally contracting from within. Japan never fully escaped. It learned to live with stagnation, stable, wealthy, functional, but permanently slower. And the tools it invented along the way, zero interest rates, quantitative easing, deficit spending on a massive scale, have since then been copied by every major economy on earth. The West adopted them after 2008. They became standard policy. But here's a question nobody wants to answer. Those tools were designed as emergency measures for a specific kind of trap. They work when the underlying economy is fundamentally sound, when the problem is confidence or liquidity or a temporary shock. They don't work as well when the trap runs deeper, when the debt is structural, when the demographics are contracting, when the balance sheet of an entire economy is underwater. Which brings us to the one country right now where all of these conditions are starting to look quite familiar. But that will be the topic of an upcoming video. But numbers are only one side of the coin. I spent quite some time living in Tokyo, Bunkyo to be exact, and honestly, I loved it. For me, it's the greatest city I've ever been to. Vibrant, beautiful, safe, and endlessly interesting. And that's the point. Japan's stagnation was never a collapse. It was quieter than that, a whisper, a slow, invisible ceiling, an economy
that stopped growing in a country that by every other measure remains exceptional. Salaries didn't crash, society didn't fracture, life for most Japanese people remained good. What was lost was harder to see. Opportunity, dynamism, the sense that the next year would be better than this year. A generation that entered the workforce expecting the same trajectory their parents had and found instead that the escalator had stopped. That is what 30 years of stagnation actually looks like from the inside. No disaster, just stillness. And out of that stillness, out of those decades of near zero rates and a currency that nobody wanted to hold, came something that Japan never intended. A side effect so large it eventually dwarfed the original problem. Something that spread silently through the entire global financial system, hiding in plain sight for 20 years. The world didn't stumble into that something by accident, it ran towards it. The mechanism was quite simple. Borrow cheap yen, convert to dollars, buy higher yielding assets like US treasuries, and then pocket the spread. And basically everybody used it. Banks, hedge funds, pension funds, trading desks, private investors, anyone who could access cheap yen for years, for decades, building positions so large and so interconnected that the whole thing became one of the biggest financial bets in history. All of it resting on one assumption that Japan would keep rates near zero forever. For a long time, it did, and the trade that grew out of that assumption has a name: the yen carry trade. Trillions of dollars built on the foundation of one country's 30 years of stillness. And right now, for the first time in decades, that foundation is shifting. Thank you for watching until this point. If you've enjoyed this video, consider liking and subscribing for more content. And if you have any feedback, I'd love to hear it. Have a good one.